For over a decade, the global economy was awash in cheap money, an era defined by near-zero interest rates and abundant liquidity. This environment fueled unprecedented asset appreciation, venture capital booms, and seemingly endless growth. But the tide has dramatically turned, ushering in a new paradigm that many are calling higher for longer. But today, we delve into this fundamental shift, exploring its catalysts, structural implications, and profound reverberations across every corner of the global economy.
The catalyst for this dramatic shift was the inflation surge following the COVID-19 pandemic and subsequent geopolitical events. Central banks globally, initially underestimating its persistence, were compelled to embark on the most aggressive rate hiking cycle in decades. We've seen benchmark rates climb from effectively 0 to over 5% in major economies, a move that fundamentally reprices risk and opportunity. The yield curve, historically a reliable recession indicator, has inverted sharply, signaling market anxieties about future growth. Market expectations for a rapid return to pre-pandemic low rates have largely evaporated, replaced by the sober reality of elevated borrowing costs persisting for the foreseeable future.
For ordinary people, the higher for longer reality isn't just a headline. It's a stark, immediate financial squeeze. Mortgage rates have doubled or even tripled in some markets, pushing homeownership further out of reach for many first-time buyers. Existing homeowners on variable rate mortgages are seeing their monthly payments skyrocket, consuming an ever larger portion of their disposable income. Even everyday purchases funded by credit cards are becoming significantly more expensive, with average interest rates often exceeding 20%. The dream of refinancing existing loans at lower rates, once a common strategy, now seems like a distant memory for millions of households.
Central bank messaging has become unequivocally clear. The fight against inflation is paramount, even if it entails economic pain. Policymakers are acutely aware of the dangers of entrenched inflation expectations, which can become self-fulfilling. They prioritize bringing inflation back to target, asserting that stable prices are the foundation for sustainable long-term growth. The anticipated pivot to rate cuts has been repeatedly delayed as economic data continues to show resilience and persistent price pressures. This resolute stance signals a departure from the reactive, accommodative policies of the past 15 years, emphasizing vigilance.
While immediate inflation was the spark, the persistence of higher for longer hints at deeper, more structural forces at play. This isn't merely a temporary adjustment, it reflects fundamental shifts in global economics.
Several structural factors are contributing to a higher neutral rate of interest, the theoretical rate consistent with full employment and stable inflation. Persistent supply-side constraints, exacerbated by a partial deglobalization and a reshoring movement, mean that goods and services are inherently more costly to produce. Labor markets globally remain remarkably tight, with demographic shifts and evolving worker preferences contributing to upward wage pressure. Furthermore, massive government spending globally, necessary to combat various crises, has led to significantly higher national debt burdens. These expanding fiscal deficits often require higher yields to attract bond investors, putting upward pressure on interest rates across the curve.
From a consumer perspective, the underlying structural drivers feel like a constant upward creep in the cost of living. The energy transition, while necessary, involves significant investment costs that are often passed on to consumers. Housing supply shortages, particularly in urban areas, mean rents and property prices remain stubbornly high, regardless of mortgage rates. Labor repricing, while beneficial for some workers, simultaneously drives up the cost of services across the board. These fundamental cost increases are not easily reversed, making higher for longer less about a central bank decision and more about an economic reality.
Central banks are now grappling with the realization that inflation may not be as transitory or purely demand-driven as initially believed. The political economy of monetary policy has shifted, with a greater emphasis on stability over growth, given the recent inflationary shock. Investment decisions at the corporate level are now fundamentally reevaluated through a lens of higher long-term capital costs. This means projects with marginal returns or those heavily reliant on cheap financing are being shelved or rescoped. The era of growth at any cost, often funded by accessible debt, appears to be drawing to a close.
The impact of this new paradigm is not felt uniformly. A significant divergence is emerging between institutional strategies and consumer realities. While some institutions find new opportunities, many ordinary households face escalating financial stress.
Corporations are confronting a substantial debt wall as trillions in low-cost debt mature and need to be refinanced at much higher rates. This refinancing challenge is particularly acute in sectors like commercial real estate, where property values are declining while borrowing costs soar, leading to a wave of distressed assets. Mergers and acquisitions activity has also significantly slowed, as the cost of financing large deals becomes prohibitive and valuation models adjust. Zombie companies, those perpetually reliant on cheap debt to service existing liabilities, are now facing an existential crisis. Conversely, financial institutions like banks and insurance companies are paradoxically benefiting from higher net interest margins as their lending income outpaces their deposit costs.
Consumers, however, are experiencing the sharp end of this divergence, often seeing their financial situations deteriorate rapidly. The cumulative effect of higher mortgage payments, surging credit card interest, and increased car loan costs is eroding household budgets. Many families are depleting pandemic-era savings, leading to a noticeable decline in overall financial resilience. Discretionary spending is being aggressively curtailed, with consumers trading down to cheaper brands or delaying significant purchases like new appliances or vacations. We are seeing a marked increase in delinquencies across various credit categories, signaling deeper distress beneath the surface.
Institutional investors are actively reallocating capital, moving away from high-growth, low-profitability ventures. Fixed income assets, once shunned for their meager returns, have seen a resurgence in popularity due to attractive yields. Private credit markets, while still active, are recalibrating their risk premiums and becoming more selective in their lending. We are observing stress in specific segments of the financial system, such as regional banks grappling with duration mismatches in their bond portfolios. Across all asset classes, there's a broader repricing of risk, compelling companies to prioritize strong cash flow generation over mere top-line growth.
Looking ahead, the higher-for-longer paradigm will undoubtedly reshape global economic landscapes for years to come. Understanding these forward projections is crucial for navigating the evolving economic currents.
The immediate future will likely be characterized by ongoing debate over whether economies can achieve a soft landing or if a recession is inevitable. Unemployment rates, while currently low, are expected to rise as higher borrowing costs constrain business expansion and hiring. The path of inflation will dictate central bank policy, with any resurgence potentially forcing further rate hikes or prolonging current levels. There's a growing discussion around fiscal dominance, where massive government debt and spending influence monetary policy more than traditional inflation targeting. Key leading economic indicators, from manufacturing PMIs to consumer confidence, will provide critical clues about which path the economy is truly taking.
For consumers, the long-term implications are profound, potentially exacerbating wealth inequality and reshaping intergenerational dynamics. The prospect of homeownership may become increasingly challenging for younger generations, deepening the divide between property owners and renters. Persistent higher interest rates could force a permanent shift in consumer behavior, emphasizing frugality and discouraging reliance on credit. The ability to save for retirement or children's education becomes significantly harder when a larger portion of income is consumed by debt servicing. We might see a societal reevaluation of financial priorities, moving away from aspirational consumption towards security and stability.
For central banks, the new normal entails a more delicate balance between controlling inflation and maintaining financial stability. The tools and effectiveness of monetary policy will be under scrutiny in a world potentially characterized by greater supply-side volatility and elevated fiscal deficits. Globally, capital flows may undergo structural changes, with investors favoring regions offering higher yields and greater economic stability. Governments will face increasing pressure to manage burgeoning debt levels without resorting to inflationary measures or defaulting on obligations. Corporations must fundamentally adapt their business models, shifting from optimizing for cheap capital capital to prioritizing robust balance sheets and sustainable profitability in a higher cost environment.